From Impact Alpha, it's This Week in Impact, where we bring you some of the most interesting impact investing stories of the week. It's Friday, August 15th. I'm Brian Walsh, and this week I'm joined once again by Impact Alpha founder and editor David Bank. We'll discuss how open deal data and standardized reporting might help fix blended finance. Plus, how the Singapore-based Tsao family office deploys its capital towards impact. And finally, goodbye accelerators, hello venture studios? How emerging market investors are helping startups survive the valley of death in reaching impact at scale. That's all coming up on This Week in Impact. Hi, David. How are you doing this week?
I'm doing great, Brian. It's supposed to be the dog days of summer, but the news cycle doesn't really reflect that, I don't think.
Well, my dog is resting right now quietly on the couch, so she certainly is enjoying the dog days of summer, paying no mind to the news cycle. But speaking of news cycle, first up, how to scale blended finance. Backers believe this de-risking and structuring approach has enormous potential to unlock private financing for emerging markets. Yet the market continues to operate at subscale. As our Eric Stein reported this week, the Columbia Center on Sustainable Investment proposes a fix, a consolidated open access data platform for deal level details. David, what's the theory of change behind this proposal, and how might this address some of the challenges in the blended finance market?
Well, blended finance, again, is one of these ideas whose time is always coming, and it does make a lot of sense of, parceling out the risk in different tranches to different investors who can take different parts of a deal and put it all together, and you can maybe move some capital that otherwise wouldn't move. We call it, broadly speaking, catalytic capital, but blended finance tends to be the emerging market sort of sustainable development version of it. And it did do about $18 billion in deals last year, which kind of sounds like a big number, but the sort of financing gap for the sustainable development goals is estimated at something like $4 trillion a year. So it's always been sort of a drop in the bucket. And the question is, could it scale up, if only something? And the newest proposal is that, if only there was more transparent data. And I do think that that's a key factor, and folks to be able to see kind of how these deals get put together, what the performance is, get comfortable with the risk profiles and that sort of thing. But I don't think that's really the gonna unlock the trillions in any way. I think that's much more of a function of the appetite and the intention and frankly the leadership of some of the bigger players, in particular the big pools like pension funds and insurance funds and sovereign wealth funds to get into these kinds of mechanisms.
Right, and when we're talking about billions to trillions, it's important to remember that a trillion is 1,000 billion. So that's a big leap. And if we're talking about going from 18 billion to something in the order of a couple trillion, then that's quite a scale up that has to happen.
Well, and indeed, and the biggest blended finance transactions, which are much bigger than they used to be, are about $1 billion now, and we've written about the SDG loan fund and others like that, and they're great deals, and they're very innovative and ingeniously put together. The Columbia Center, as you said, says let's have not just the open access deal platform, but all the kind of standardized reporting templates and term sheets and metrics, and then everything can be comparable and benchmarked. And again, this has kind of been the holy grail. And there's nothing wrong with it. In fact, it would be terrific for people to have that kind of visibility into the market. And again, but it does take leadership. So there's been something called the GEMS database, the Global Emerging Markets Risk Database, and the development finance institutions have been keeping track of their loans for decades and have the deepest probably data set on repayment rates and real risk profiles of different kinds of loans. And it's been kept pretty much closed up. There have been some recent efforts in recent years to kind of pry open parts of that data, but the sort of raw underlying data has always been kept as kind of a trade secret among those kind of DFIs. And so again, yeah, it would be great to open that up and to let people see, that maybe those emerging market loan are not as risky as they thought, and therefore maybe the risk premium would come down, the cost of capital would get lower. But again, for that really to open up, there's going to have to be much more capital flowing, and again, not just from these development finance institutions, but really big pools of private capital.
So why are the participants in the GEMS database reluctant to share that data? And I know there might be some confidentiality issues or contracts that they have in place that prevent them from sharing the performance data and some of the other even non-performance data from their investments. But what's the case for keeping this data closed?
Well, I mean, there's probably lots of different theories, and I think the leading ones are the data may be messier than we think, and maybe it hasn't been kept all that well, and maybe in some cases, the deals didn't do that well, although that would have cut against my thought about the risks being lower than perceived. And then, of course, folks think hey, it's a kind of competitive advantage if you know something about the market that others don't know, then you have an edge in underwriting those deals, both on the upside and on the downside. So some version of all of those reasons, I'm sure, come into play. And like I said, there's been a lot of effort over the last few years to kind of pry it loose. There's something called the Publish What You Fund effort that tries to rank and kind of name and shame the DFIs into disclosing more data. Convergence, which does the blended finance kind of matchmaking in some cases and sort of has a database of deals and tries to put things together, has its own database. And so there are, pockets of data that are coming out. And the Columbia folks said, all that's good, but we need more and we need it to be more standardized.
And so, what are the levers that can be actually pulled here to kind of influence those DFIs and others that have this data to actually share? Because right now it's all self-reported. So, what kind of pressure can be put or brought to bear to encourage them to open up?
Well, there is generally a push for sort of more transparency. I mean, just in the sort of AI context, more data is kind of coming to be known. There's so many kinds of, sensors and metrics out there for deforestation, even from satellite data and that sort of thing. So broadly speaking, I think things are becoming more transparent, and I think that as the DFIs in particular see their role as kind of catalyzing other capital to come into the market. The easiest way, and this is basically what the Columbia folks argued, the easiest way to get folks into the market is to give them the assurance that those investments, will be, those loans will be repaid and those investments will be good. So I think, things are sort of moving in the right direction, but there has to be, again, leadership from some of the key folks and sort of, leading by example.
David, we also had a guest post this week from Florian Kemmerich of capital advisory firm Human Planet, making the case for using AI to help solve the blended finance scale challenge. So, what is the case that he was making?
Well, yeah, and Human Planet is the newly renamed Cois Advisory, which restructured recently. And yeah, I mean, it's again this notion that the advent of AI as a way to pull all this data together could make these complex transactions simpler. That would reduce the transaction cost. Some people call it the complexity premium in these deals. And I think that's true. I don't know that it's proven out exactly yet. AI has its own costs and downsides, as you well know. But there is a notion that if these risks are really what we think they are, and that these deals can be structured in a way that keeps everybody's risk appetites satisfied, and that becomes sort of more of a standard part, as he called it, of the practice in the global capital markets, then we could get capital pointed towards the Sustainable Development Goals and other metrics like that, make that kind of exponential progress that's needed, and as he says, move blended finance from niche experimentation to institutionalized mainstream investing, and AI, I think, is certainly going to be part of that transition.
Yeah, and AI can help with things like streamlining due diligence or automating impact measurement and reporting and kind of enabling real-time portfolio monitoring using satellite tools and other kind of data sources beyond just the self-reporting of the players in the space themselves.
Yeah, all that keeping track is a big overhead, and so let's try to make that as painless as possible.
All right. Well, you can read Eric Stein's article on a fix for blended finance and Florian Kemmerich's guest post, both on ImpactAlpha.com. There's also links in our show notes. Later on, we'll discuss how some investors are turning away from accelerators and towards venture studios to build enduring startups. But for now, let's take a quick break. When we come back, how a Singapore-based family office expands the LP pool for impact strategies in Africa. Perceptions of risk are often what deter investors from emerging markets. But a Singapore-based family office, comprised of fourth-generation siblings whose wealth stems from a maritime trading and logistics company, is seeking to act as a catalyst for other limited partners to invest for impact. Our Jessica Pothering reported on the Tsao family office's approach, whose chair helped kick off the Global Impact Investing Network's Asian Impact Forum last month. So, David, what did we learn?
Well, we love this story. The Tsao family office is a Singapore-based family office. They have been showing up in a number of deals, and we reached out to them and had some very good conversations about how they see risk and return, and their kind of private family wealth turning their assets towards kinds of deals that have generally been the province of those kind of development finance institutions. And so we wrote up one in particular that was a kind of very kind of private credit mechanism to provide dollar-based loans to emerging market companies, particularly Africa companies, that needed to do loans in dollars, and their local bankers, just don't have those kind of dollars or didn't want to tie them up. And so they get referred to this TLG Capital's Africa Growth Impact Fund. They make the dollar-based investments, get paid back in dollars. It's not all that risky, but again, it had been something that the development finance institutions had covered. And Tsao was kind of notable for being a private family office getting into that deal. And so it was one of their first deals in Africa. And so a sort of Singapore-based private family office getting into a kind of catalytic private credit deal to finance business in Africa, we thought was a new development.
Yeah, and Singapore is quickly emerging as a hub for investments in impact and climate action and sustainable finance overall. I mean, we've talked about Temasek before, which is the huge state-owned global investment company that has really gotten involved in the impact land in a big way. Tell us about that.
Yeah, I think they've sort of set the tone, and there's other family offices as well. And I think a lot of it is, or some of it at least, is the spillover as folks have moved from Hong Kong in recent years, and Singapore has become a hub for so many things. In fact, the Tsao family itself has roots in China. The business itself is kind of in the fourth generation, started in China, moved to Hong Kong, and then in 1991 moved to Singapore. And as you said, the Jin just had a conference there that the Tsao family office was involved with. And there's something called Impact Week coming up next month in Singapore. That's kind of like a climate week for impact with events all over town. So I think a lot of folks in the impact world are finding their way to Singapore.
One thing I thought was interesting from Jessica's article about the Tsao family office is that they report that 51% of their portfolio is impact and sustainability focused. So 49%, they say, is screened for do no harm. 51%, so a majority, is simple majority, but a majority is impact and sustainability focused. And of that, 15% falls into the deep impact category. I just think that's an interesting breakdown, that 49, 51, and the 15 of the 51 going to deep impact. That's an interesting model for other organizations to consider.
The deep impact, I think they mean, catalytic, maybe takes more risk or accepts lower return and brings other folks in. They're into funds like the Blue Orchard Microfinance Fund, and there's the Wellington Global Impact Bond Fund. They backed a fund manager in India called Omnivore that we've written about. That's in agriculture, a healthcare investor called Somerset Indus on the private equity side. And like I say, Tsao is finding its way into a number of deals that are kind of the mainstay of what ImpactAlpha has been covering. And then, as you say, a bigger portion of their holdings are in what would I guess be called ESG funds or screened funds in various ways for sustainability, generally speaking, in public markets and things like that. So they're moving, I think, more, as you said, they've crossed the 50% line on that. And I think, as they said, that as they get sort of more comfortable with these kinds of deals with new geographies like Africa that they haven't been working in very much, they would move more of those assets to the screened and ESG sustainability side, and then presumably even more into the deep impact bucket as well.
All right. Well, you can read Jessica's piece on the Tsao family office on impactalpha.com. There's also a link in our show notes. For now, let's take one more quick break. When we come back, how some investors are turning away from accelerators and towards venture studios to build enduring startups. For decades, some emerging market investors turned to accelerators to help nurture and scale up startup businesses. But with many businesses facing the so called valley of death in funding, our Lucy and Gigi reported this week on how some investors are turning to so called venture studios as a way to build more enduring startups. So, David, what are we learning about this venture studio approach?
Well, it's not just in Africa, but it is also in Africa and elsewhere. And as you said, there's a lot of support for very early stage. There's all kinds of contests and incubators and accelerators. And folks can get, very, usually quite a small amount, but just kind of get their idea going. And then the real problem comes when you need the kind of scaling and growth capital to get to sort of what might be a Series A kind of thing. And so there's been a huge sort of fall off. And one of the thoughts is from some of the investors is, hey, we know kind of how to build these businesses. Let's just kind of make it happen instead of kind of selecting from the founders and entrepreneurs who come through the door. And so it's a little bit of a retreat in a sense from kind of supporting a kind of fully, organic, as it were, entrepreneurial ecosystem. And it's a little bit more of the sort of more professionalized investors saying, let's put a team together around a thesis that we know and we've researched and we'll know how to put all the, levers together and drive the revenues and build this to a big company and kind of push it through with our own muscle and our own talent. And so, there is some maybe anecdotal evidence that can be successful. There have been some exits. We wrote about it, Enview, this Netherlands-based venture builder. And what was interesting, actually, I think the story came about because of their experience building something called the People's Pension Trust in Ghana. And it was a kind of micro pension scheme for informal workers, and people would, make small deposits into a sort of electronic bank account kind of thing, and then have pensions and sort of social insurance for themselves. And it was a good idea. They needed to not only build the business, they needed to kind of get the regulations approved, that so that such a thing could exist, and they just took it on themselves, built it, and now, some number of years later, they've got something like 23,000 clients, and they've raised some additional money from other investors, and so again, anecdotal evidence that these kinds of kind of brute force, do-it-yourself, DIY, we've called it, investments can be successful. And Envio's done, a number of dozen of them. I think they've got a dozen, active in their portfolio. But there's something called Fundamental in Mexico City, spun out from a kind of NGO and has done a number, I think 4 in Mexico. The US, there's something called Montauk Climate that we've written about, has launched 7 climate tech companies, and one of them just raised a subsequent seed round. So it's kind of catching on as a way to kind of accelerate as opposed to go through an accelerator.
I think the flip side of this is that when you have an accelerator, you have an entrepreneur that you're backing, and an entrepreneur is hungry and they're looking to grow their idea and their business, and they need support and they need resources and they need other kind of sources of capital and other things to help them take their idea to scale. But when you have a venture builder or a venture studio, you kind of are doing entrepreneurship by committee, if you will, by the investor themselves and not by relying on that kind of hungry entrepreneur.
Yeah, it's a more top-down model to be sure, and I think that would have both pros and cons, as you say. And the con is, that there was a kind of, frothy, scrappy entrepreneur kind of ethos that that was appealing and sort of made everybody think that they could have a shot. And then the studio model is much more kind of stepwise and sort of maybe a little older, more mature, and it might be more exclusive in terms of letting folks get into business. But that's also because some of these things, now require much more capital to scale up. Some of them are, sort of private credit lending kind of businesses that are much sort of bigger than what a sort of small startup can bite off. Sometimes the corporate off takers or customers, want a little more assurance that their supplier is going to be there when they need them, and so they don't want to back these super startups. And so it is kind of a maturation of the business and perhaps a little less romantic. But there you have it.
All right. Well, if it gets the companies to scale, then maybe it's worth it. All right. Well, you can read Lucy's article on venture studios on ImpactAlpha.com. There's also a link in our show notes. But for now, that's going to do it for this episode of This Week in Impact. Thank you so much, David.
Thanks as always, Brian. It's fun.
And thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network. Smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks as always to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh, Managing Director of the impact advisory firm Human Nature. We'll see you next week for more Impact.